We've just received the final piece of labour market data for the year, and it showed that employment fell by a bit over 21,000 in November. Now, this came as quite the surprise to us and the market, but we know that monthly figures can be a little bit more volatile in the run-up to summer holidays, so there's likely a little bit of noise in the mix here. On average, employment data has been on the softer side in recent months, and as a result, the annual growth pace continues to follow a gradual softening trend, currently at 1.4% on a 3-month average basis. Underneath this slowing in jobs growth is a diverse set of industry narratives. The main driver of the slowdown so far has been the care economy, where jobs growth has now come back down to more sustainable levels after a monumental hiring effort over recent years. But when we look at other parts of the economy, we're seeing some signs that a pickup in consumer spending is starting to flow through more broadly into employment. So far, this has mainly been seen in hospitality and personal services. And although we're starting to see jobs growth lift in the tourism and retail space, it still looks to be relatively early days. Now, although there was a fall in employment in November, this didn't end up causing an increase in unemployment. Instead, we actually saw more people leave the labour market entirely, seen in the participation rate falling down to 66.7%. This meant that the unemployment rate was able to hold steady at 4.3% in November. But overall, it looks like the unemployment rate is trending steadily higher. We think there is still some room for this to continue over the next 6 to 12 months, with the unemployment rate forecast to reach a peak of 4.6%. The key takeaway from all of this is that the broader trend of a gradual softening in the labour market is still intact. This will give the RBA enough bandwidth to remain squarely focused on inflation developments over the coming months.